Yeah, first I think I would say that if I can get 20 plus times EBITDA multiples from the businesses and consumer, I'll take that all day long. I didn't even see that in 2021, which was like the career year for everybody in consumer and probably in investment banking overall. But I think, it's interesting in consumer because you kind of feel like there's always something, right? So it was many years ago, it was the tariffs that were impacting valuation. And then, you kind of get past that because people were pricing that in at retail, at brick and mortar, Amazon, whatever. And then you have the pandemic. So then the big question that private equity and strategic is always asking when it comes to valuation is, okay, what is the COVID bump here? What is the truly normalized level of your businesses? And so you're not going to get full credit for the EBITDA that it's growing towards. So you kind of get past that. And then, of course, last year we had supply chain, where you had container rates going from $1,500 to $2,000 a container all the way up to the 20, 25, 30,000 sometimes. So obviously that impacts your COGS. To the point that Steve was making on adjustments, they're massive. I mean, yes, they're all explainable, but there's a certain limit on the number of adjustments that any PE firm is going to look at, and certainly the lenders are going to accept. So now we're in an environment that we've gotten past. I guess the latest was probably the retailer inventories at Walmart, Target, Costco, Amazon even were high in kind of Q4 of last year and Q1 of this year. That has started to normalize. So we're starting to see some resurgence there. And in certain categories, POS is still remaining resilient. So, when we're going out to market and we're thinking about valuation, there's characteristics of certain companies that are going to be more appealing than others in this market in particular. It's like if you're a fully consumer discretionary business with not a lot of recurring revenue, it's going to be much tougher to have a successful valuation in this market. I mean, the bar for consumer discretionary at the IC level, the investment committee level for private equity firms is so much higher now. So you really need to the point you were making on, if it's an A asset, it makes sense to go now, but even still, the valuation levels, as Steve was saying, I'd say for us, it's probably a turn and a half, sometimes even 2 turns lower. In some respects, it's because of the 5% increase in interest rates, but It's also just because of how people are looking at this sector and consumer. I mean, I'd say, and I shouldn't just put all consumer together because there's consumer durables and discretionary and household where I work. Then there's where people are kind of orienting towards nowadays. It's more on I'd say the consumer services side. Again, big recurring revenue model. And then on the enthusiast side also, there's still a good amount of interest. So I guess it's very different across the different verticals that we all participate in.